I'm Josh Denbo. I'm an attorney, consumer advocate, consumer practitioner. I run my own consumer protection law firm. Most of my work is protecting secure debtors from bad faith collection, from harassment, from losing their homes, from dealing with predatory car dealers. I also deal with credit problems and improper credit reporting, a whole bunch of other things. If you've been screwed by a finance company or in a transaction, I probably know a lot about how to deal with it. What I want to talk about today is going back 2008, 2007, and before that, when we ran into the Great Recession as a result of the crazy real estate bubble popping and all those big companies going out of business like Bear Stearns and those other jerks that blew up the world's economy. So how did that happen? What did Congress do to stop it from happening again? How does it affect today? And how can you use what Congress did to protect you now and going forward? I know it's a big mouthful. Look, there's a whole bunch of theories out there that you've probably read about. You've had, you've been to friends' houses and you're going to cocktail parties and people are talking like they know what they're talking about. And maybe they know something I don't, but I doubt it. Look, I probably consulted with 4,000 people dealing with foreclosure on their homes. And that's not a joke. It goes back to 2008. This has been a long time. I've represented over 1,000 for sure, probably over 2,000 people litigating against banks in foreclosure cases, from anything from straight up foreclosure fraud to servicing fraud and abuse to just someone running out of money and needs to find a way to fight back to get themselves back on track and save their house, if they can. So I come from this from a perspective where I understand the finance industry from the granular detail of all the legal requirements of lending finance to consumers. And I see it from the consumer perspective. And because I'm an attorney and I litigate in federal court against banks all the time in this area, I have a certain level of expertise. Let me tell you I think the reason why, from the statutory, from a legal perspective, from a law structural perspective, the reason why we ran into this disaster in 2008, what the fix was, how banks are kind of doing it again, and how you can protect yourself and fight back. Here it is. Prior to 2010, there was no law on the books that required a mortgage lender to really make a determination that at the time of the closing of the loan, the borrower, the homeowner, had the ability to repay the debt. It may not sound like a lot, but if you can sit back for a second and think about what it means when a financial industry looking to close more deals to sell to the secondary and the tertiary market couldn't find more people who needed homes who could afford it, you ended up pushing deals that people could not afford. The lender knew they couldn't be afforded, but because the secondary market was making money, putting them in the tranches and selling the securitizations and all this happy nonsense or unhappy nonsense, there was a press to close as many loans as possible, and there was no legal requirement that a mortgage lender at the time of origination make any good faith determination that the borrower could afford the payments, could afford the loan. I can go into more details, the type of products that were created to make it look like to the consumer that they could afford the payments, but later on it would definitely fail. But that's too big for this. Here's the change that was made in 2010. And the statute in question, which should have been amended at the beginning to require this, is called the Truth in Lending Act. It's also known as TILA, T-I-L-A. It's, if you want to look it up, I'll have a site below to the specific section, but it's 15 United States Code 1601. Okay? Here's the section that was added in 2010. It's 15 USC 1639C, or I guess you're looking at the C, with the letter C. In accordance with regulations prescribed by the Bureau, that would be the CFPB, no creditor, meaning the original lender of the loan, may make a residential mortgage loan unless the creditor makes a reasonable and good faith determination based on verified and documented information. No more, no document loans. that at the time the loan is consummated, closed, issued, made, the consumer has a reasonable ability to repay the loan according to its terms and all applicable taxes and insurance and assessments. That's all it says. What does that mean? What it means is that the lending industry has to make the determination that the statutory crafters back in the 70s when Truth in Lending was issued believed they would make all the time, which is we don't want to lend to someone who can't repay. But with the change in the industry where the benefit to the issuer of the loan was selling of the loan rather than collecting on the debt, there was a disconnect between the business needs of the seller of the issuer of the credit and the borrower that people in the 70s, the government in the 70s didn't expect there ever to be. But there was, and we know what happened. Okay, that's the statute. What happens now now we're going to face a problem here, which is we used to have, until the last 2 years, houses selling like hotcakes. Bang, 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 all the time. Loans being issued, bang, 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 all the time. And as I said, other places, when you have a situation like that, where the hunting is easy from the perspective of the original creditors, they can go out and they can sell, they can finance all the time. They don't have to have any skill or ability or really know what they're doing because there's so much business. They can go out and make these loans. That happened the last 2 years. It's coming downhill. We're going to sell fewer houses coming forward, a lot. We're going to finance fewer deals because the houses are selling less, a lot. And that's going to create a pressure to sell bad loans. Just is. And it's hard. And before 2010, I couldn't do anything about it. I litigated in state court to the appellate division. The Supreme Court of New Jersey refused the 2 cases I brought to them. Shame on the Supreme Court for this. This is back in 12, 13, 14. Where I argued that the creditor sold a loan that they knew my client couldn't afford. They even falsified my client's records, his ability to pay the debt in order to close the loan to sell it. And that was a breach of a financial obligation, of a fiduciary obligation that triggered the Consumer Fraud Act protections in New Jersey for the benefit of my client to protect her from losing her house because she got scammed by a seller of the loan. But the statute I just read didn't exist. So the court's position was, listen, if Congress didn't say that the original lender had an obligation of good faith, fair dealing, fiduciary reasonableness, not to be a complete jackass to their own clients, their own customers, the consumers, then we're not going to create one for you, Mr. Denbo. Go home, get your client out of here. It was disgusting. It was not the court's best moment. Not their worst, because they did a lot worse than that. But it was bad, real bad. Truth in Lending comes along and says, we're putting a stop to that. You have to, meaning original creditors, you have to make a determination that your customer can afford the payments. What's going to happen now? What's going to happen now is as the number of sales goes down, the number of fraudulent finance deals is going to go up because these companies, these original creditors are fighting harder and harder to make the business. And they're going to fudge things. I already talked about how the Truth in Lending Act is going to give us some relief when they change the terms from the pre-till disclosures to the final sale disclosures. But here's the statute here's the section of the statute that makes those sellers liable for putting someone in a loan they can't afford. It's going to be a pretty big business for consumer protection attorneys around the country coming forward. And I haven't seen a single video about this out there. Nowhere. I've been looking for the last 30 minutes, an hour. I've seen guys who don't know what they're talking about with a fancy board and back with the word Truth in Lending and the statute written out in marker on the whiteboard, talking as if they know what they're talking about and giving useful information, but they don't and they're not. Here's the useful information. If a lender puts you into a loan that you can't afford at the time of the application and then you fall behind, you have a case, I either want it if I can cover it, or I want to get you to somebody who can handle it. And I want people to, but more important than that, more important than me making money here and suing banks, I want you to know that you've got rights. And I can point you in the right direction. Okay, I only cover one state, New Jersey. But I can point you in the right direction no matter what, just about no matter what state you're in. I don't think I know any attorneys in Alaska. But other than that, and oddly enough, Delaware, don't got an attorney in Delaware. I'm in New Jersey for crying out loud. I can't figure this out. Delaware lawyers, if you're watching this, call me, all right? I have business I keep needing to refer out, but I can't find a good Delaware attorney. All right, so what I got here is we're going to see fraudulent lending. You have rights. They're good cases. And how to prosecute them. I know attorneys in other places know how to prosecute them. Reach out. Let's talk, all right? Listen, I hate banks. I really hate loan originators who cheat people, but I like you.